This video is looking at capital gains tax. Capital gains tax commonly applies to capital assets acquired on or after the 20th of September 1985. When capital assets are sold or disposed of, any net capital gain made or loss incurred is reportable in your income tax return. A capital gain arises where you sell or dispose of the capital asset for more than the cost paid to acquire it. Tax is then paid on the net capital gain. A capital loss arises where you sell or dispose of the capital asset for less than the cost paid to acquire it. All capital losses are quarantined for offset only against capital gains and can be carried forward to later income tax years indefinitely. Capital gain tax applies when a capital gain tax event is triggered. It is important to know the timing of the capital gain tax event to ensure any capital gain tax liability is recorded in the correct income tax year. One of the most common capital gain tax events is Capital Gain Tax Event A1, disposal of a capital gain tax asset. Capital Gain Tax Event A1 will generally be triggered when a contract for sale or disposal is entered into. Common capital gain tax assets captured by Capital Gain Tax Event A1 can include shares, land and buildings, and goodwill on the sale of a business. You must maintain complete records relating to actual or potential capital gains or capital losses. The records must document the nature of the act, transaction, event or circumstance, the day it happened, who did the act or who were the parties to the transaction, how the act, transaction, event or circumstance is relevant to working out the capital gain or capital loss. Common examples of records to keep include receipts, market valuations, income and expense records and loan statements. Some capital gains or losses may be exempt where they relate to an asset acquired before the 20th of September 1985, your car, certain low-value collectibles and personal use items, and your main residence. The main residence exemption may be available where your property has a dwelling on it that you and your family live in with your personal belongings. Is the address appearing on the electoral roll and where your mail is delivered to? Has services connected, for example gas, electricity? The length of time that you stay in the dwelling and your intention in occupying it may also be relevant to determining whether the property is your main residence. The full main residence exemption may be available where the dwelling has been your home and your family's for the whole ownership period, has not been used to produce assessable income, for example not used to operate a business, not rented out or flipped, is on land of 2 hectares or less. Otherwise, you may only be eligible for a partial main residence exemption. A property is no longer considered your main residence when you cease living in it. However, you can continue to treat the property as your main residence for CGT purposes for up to 6 years if it was used to produce assessable income. Indefinitely if it is not used to produce assessable income. Another property cannot generally be treated as your main residence simultaneously. The general 50% discount may be available for some capital gains, for example Capital Gain Tax Event A1, made by an individual taxpayer where the asset has been held for longer than 12 months. Please seek assistance from the Australian Tax Clinics or the Australian Taxation Office if you need any further assistance on capital gain tax. Thank you for watching our video.